Welcome, everybody, to another episode of the Gold Silver Bitcoin Show, brought to you by the GoldSilverBitcoin.com store. We are more than honored to be sitting down today with Ted Oakley. He's the managing partner at Oxbow Advisors. Thank you so much, Ted, for joining us today.
Thank you, Justin.
You had a discussion with a friend of yours, Dr. Lacey Hunt, I believe, and he mentioned in this interview that the indicators he was looking at were more negative than they had been in 9 decades. I guess that might put us back in the 1930s. Do you share that assessment with Dr. Hunt?
Well, I think what Lacey is looking at would be the level of indebtedness, not only of the U.S. government, but also of individuals, of companies, and that sort of thing. And what happens is when you have that much debt, you can't get really, the growth can't really come on strong. You spend most of your money really trying to pay interest in principal. But I think that's where Lacey comes from in general. And the second place is I think he comes from is it would be very, very hard today with the voting populace to create say a few years of austerity where people had to really tighten up. And he didn't he thought at least that we didn't have the ability as a group now to do that right now. And I would probably agree with that. I think we're in fairly tough space right now. Number one, the individuals are completely in the market, which they were in the 20s. And secondly, we have the speculative fever in almost every asset class. So I think that as much as anything, I think that's where we are.
On the topic of the indebtedness, it's probably more than 30 trillion at the time of this conversation. As far as I understand, there really is no precedent in history such indebtedness as relative to GDP. Can you think of any examples that we can kind of look to for as a guide?
Well, the last time we were at this level, and if you take total debt, it's about 390% really of GDP. I'm using not just government debt, but total debt. We had that 1930 in the early 30s, and so we've had it before, and we had actually a lot of government debt relative to GDP at the end of World War II. It was very high, it was 100 and something percent, maybe 100. I can't give the exact number, but it's over 100. Then we went, that actually moved down until the 80s, and we ended up at about 35%. Government debt to GDP. So it's happened before. It's just been a long time.
And then as a group, us perhaps not wanting to go through the austerity, I suppose, has a lot to do with the way in which the election system works, with elections every 2 to 4 years, which of course is a foundational aspect of our political organization. But are you implying that you don't think the politicians have the will or to really kind of put their election on the line and start talking about austerity?
That would be a yes, and I'll tell you why. I've never seen politicians put their own personal situations above the government. So I mean, below the government, they've always put themselves in front, in my opinion, at least. I mean, we haven't any austerity in so long. Nobody even talks about it, either party. You never hear them talk about the budget or a balanced budget or anything like that. And that's just gone by the wayside. It's like, that doesn't exist anymore. So that's the problem you have right now. You don't have anybody willing that's in government or almost out of government to bite the bullet right now.
So you have at Oxbow Advisors 3 different investment strategies. I believe there's a high risk one, a conservative one, and a growth strategy as well. You've mentioned that your conservative strategy is bulletproof. What do you mean by bulletproof, and what kind of factors are you looking at when developing that conservative portfolio?
Well, what we look at in the conservative, and I'd use that as it's obviously not 100% guarantee. I will say this: we never had a down year in it, but there's a reason for it. We only buy really, really high quality items in that conservative that portfolio. If you look at it, it's treasuries, it's CDs, it's very, very high grade municipal bonds. But what happens is they're mostly short term. And by that, I mean less than 48 months. So it's hard to get hurt like that. In addition, when you have breaks in the stock market, people rush to the treasury. We have a lot of them, and you'd see that as well. Now, occasionally in that portfolio, which we have just done this, we will go out and take maybe 10% of the portfolio and do a longer duration. In this case, we're doing the 20 to 30-year treasury because we think the long rates will go down as the short rates go up. But that's why that portfolio really stays very, very steady. I'm not saying it can't have a down year, but it hasn't. And when it, we've had skinny years where it's only up 1 point or maybe 1.5. But by and large, it's too short, very, very short term. So that's where it is.
And in terms of high quality assets, I believe you mean that they have a low debt, high cash flow. I'm curious, is it getting more and more difficult to find high cash flow businesses in the markets?
Well, in the high income strategy, I think that may be what you're referring to, Justin. We look for things that are not bonds. We really don't own any bonds in that portfolio, but we own a lot of different other things. We own real estate investment trusts, own a lot of prefers. We own convertible prefers, and those areas are strong for us. You'll see we own a lot of gas pipelines. You'll start to see where we own some commodity-based items, some energy. We got quite a bit of energy as well. So that portfolio overall has a very wide mix of income type items, all paying between, say, 4 and 9. And so it's a wide mix. It really covers a lot of ground, and and we also, by the way, in both of these portfolios, income, we own the gold bullion. Now, in the high income portfolio, we also own the bullion, but we also own the miners. So we own both of those.
You mentioned that a lot of the public is in the markets now, and it seems that people are using the stock market as a savings vehicle even. Can you speak to, I suppose, how that came to be and why you view it as a potential problem?
Well, what happens with the public, and I'm sure I've probably been at this about as long as anybody, maybe obviously not like Warren Buffett or Charlie Munger, but I've been in it long enough to where I've been through an inflation cycle and different things. But what I notice about individuals is this: they always are late to the game. And if you've had a game that's been on and really ongoing and doing well, I should say, for, let's say, the last 12 years, then what's happened to them is sort of like Pavlov's dogs. They get used to coming to the trough every day, and things never change. You have a 1 month bear market, and 2018 had 57 days. I mean, they're like, nothing bad is going to happen for very long. So what you've done is you've created this atmosphere where nothing's poor has happened for so long that people get in a mode of where that's what they're used to. And that's a long time, by the way, 12 years without anything drastic. Like I'm saying, like a 2-year bear market or something. That's where they are now. And most of them are all in, regardless of age. I noticed a lot of people, particularly over 65 or 70, that probably have too much stock, but they've been really around it for a long time, and they think they've got the game down. And so they've got a lot on the line, but they never have, most of them never been through serious bear markets. And I think that's the wake-up call for them, is when you have a true bear market.
I entered into the Bitcoin industry in 2012, and it's never really been such an emotional pursuit for me as much as a professional one. And in recent years, many of my peers and family have entered into the space, and there's basic fundamentals that they don't understand about it. For instance, Bitcoin, there will only ever be 21 ever minted per code, whereas Dogecoin and Ethereum have an infinite amount of supply. And these individuals don't know that simple difference between these two different types of, I suppose, investments. I think we could categorize them differently. And I suspect that there's a lot of that going on too in stock investments with the public. Now, when I look at basic economics, for instance, Economics in One Lesson by Henry Hazlitt, he discusses how money printing can lead to reckless behavior. People will be more reckless with their money. They'll either spend it more, perhaps they'll wildly speculate with it. Do you agree with that assessment that a lot of this wild speculation might have to do with the amount of money that's been injected into the system in the last 2 years?
Oh, Justin, I would say 100% I agree with that, because what happens is, you know, when you get a lot of money around and things start going up, every asset class, I'm not just saying stocks, but every asset, you look at real estate, then you don't make many mistakes. In other words, there's so much money around that, you know, you can always find somebody with more money to buy what you're selling. And so there's very few errors around because there's plenty of money around. Now, as it dries up and people spend it, then you get in a situation where for the first time, for many of them, for the first time, they'll be like, oh gosh, I can't believe my stocks have been down for 6 months or 9 months or a year. Or my real estate, all of a sudden the home, we've been able to buy homes and flip them for the last 10 years. And then all of a sudden now it's the same price or lower. So that's the kind of thing that money does. It creates so much demand out there that normally would not be there. And since it's basically free money, I mean, we see people borrowing money at 1.75%, 2%. So why not? And that's sort of what's happened with all of this.
Since 2020, I've feared or anticipated that we might be going through a period that was similar to the 1914, 1945 period. We had a pandemic. We had a pandemic back then in the Spanish flu, and we see increasingly geopolitical tensions. Has the situation in the Ukraine informed your strategy at all?
Well, not necessarily. We found that typically markets don't necessarily, you don't get bear markets necessarily from people that are in conflicts. I'm talking about countries. Initially, you do. You get these shocks from it, but I'm saying it's not normally the cause of bear markets. And I think what happened, you know, particularly in the period you're talking about, is by the time you got to 1918, 19, Germany, Weimar Germany, inflation took off like crazy, and that's what you had coming in the 20s. Then you had, all of the roaring 20s in the US, where money was free, you could borrow for nothing. And, all that created somewhat similar today, this artificial demand that normally, would not be there. But I think when you look at conflicts, could they get really bad? Yeah, they could. I mean, if you went in a situation where they were using nuclear or something we didn't expect, usually what happens with markets when they get hurt is when things happen that people don't expect. Right now, people expect Putin to keep on going into Ukraine. So that's not something that's going to be something interjected into the market. Things that hurt the market are things you don't know. And when something happens like that, a la 9/11, that's the kind of thing that hurts the market.
And I suppose 9/11, I guess in 2022, we saw the shutting down of travel, which hurt the market then, although it was only a brief period, I would say, compared to what it could have been. I guess, I studied history, and that's how I came into learning about finance and money, was kind of through history. As I graduated, I was like, well, this history degree maybe wasn't exactly going to get me ready for anything professional. I'll learn about monetary history and finance, et cetera. And so when I'm looking at what's going on globally over the last 2 years, I do think that it is, there's a lot of change that's going on. And I suppose my question is, do you sense that? And if so, could it affect the way Oxbow approaches markets generally?
Well, it could. I mean, there's a couple of scenarios that could play out here. One is that you could get a lot weaker than people expect, which in that case, you would see us get really, really aggressive, use all of our cash. And not because we're trying to time the markets, because we would find things that are really cheap, really, really cheap. Some of our very best years, if not the best years for us, have been like 2003, 2009, when the markets, we had huge returns. And the reason being was not because we're geniuses, it's just because we had a lot of liquidity. And when things were really cheap, we were able to reach in and own that. Now, if we got into a situation where we felt like, and by the way, we don't feel like this right now, but if we felt like there was going to be some sort of worldwide depression, something like along that line, that would change us. Because what we would do at that time is actually raise more cash. You have to be, when you get into a depression, you have to be liquid. I mean, really liquid, or you won't survive it. But, we haven't had a depression since, 30, 31, 32. So, I mean, and the years after that, but I'm just saying that would change us if we thought that's what the case was, but we don't see that. Don't get me wrong. I'm just saying that would be something that would affect us.
So in 2003, 2009, essentially your analysis that you had conducted prior to the event, whether that be kind of the markets crashing, or perhaps in 2003, I'm not sure what the impetus back then, maybe the Iraq war shocked markets at the time. Your analysis basically remains the same. You just have this opportunity where everything's underpriced, correct?
That's true. If you look at 03, we've gone through a 3-year bear market, really, 2001 and 2. And then in the last 12 months of it, obviously, we were building up toward, declaring war. And so everybody was like, the last 90 days of that, for example, first quarter of 03, everybody's like, oh, we'll go to war, and then it's really over at that point. Of course, we had gone so far, so deep, that created a lot of opportunity for us. Obviously, as soon as they started fighting, which we expected, markets took off and really had a big year. 09 was similar. Everybody's scared to death. And by the time you got into the first quarter of 09, it bottomed March 9th. But prior to that, and that 2 months prior to that, you could buy things that were yielding 15, 16, 18%. I'm talking about in the cash flow now. And so you can make we can make a really good case then for having a lot of money in the market, which we did. And that's effectively where we were. Always look back at your eras, Justin. And if you look at the era we had in 2020, we had a lot of money, but we didn't put it all in because we underestimated exactly how much the Fed was going to buy. We thought if you lowered rates that you would just stay in a bear market, which that would have happened. But when you got all the buying by the Fed, and on top of that, everything that came out of the government in terms of PPP, the CARES, that whole thing, then we underestimated that. That was going to be a big, big train that was going to take a lot of people with it. And while we put money in, we could have put in more. And that's, you always look back at your errors because that never happened before. I think we're more back normal now. I think it's going to be hard for the Fed to do anything like that now because they've already said, hey, we have to fight inflation. So I think we're going back into more normal markets now, but we'll see.
I've heard world leaders suggest that the money printing that we saw, the quantitative easing of 2009 and the recent injection into the economy are having diminishing returns, I suppose. And is that what you mean by a return to normal markets, that we won't have this option to just inject liquidity and prop things up?
Well, if you go back historically, Justin, look at it, okay? And this information is available. And you go back and look at, say, the last 50 years or so, and you look at debt, okay? And every dollar you borrow as a country, I'm talking about the country debt now, you borrow, and then you look on the other side and you say, well, how much is that? If I put in $1, if I were putting in $1 into a brand new business, I'm expecting to get my dollar plus a return on top of that. So let's say I get my dollar back and I'd get, in particular in private business, maybe a 20% return on that in private business. Well, in the government, they've been putting dollars in, and they've gone now from what was years ago at you put $1 in and you're getting, close to $1 out, 75, 80 cents. Now you're down to 30 cents. So that keeps declining. So all of a sudden you're at the margin of everything. And so you put in $1. What if you put in $1 of debt and you get 1 month of GDP that helps you, just a month or 2 months? That's all you get. Then all of a sudden you took on more debt, but see, you're right back to where you were, but you just have a lot more debt. And so debt becomes an ineffective tool after a while. And you can look at it in Japan. That's the perfect place to watch it. It's been going on there now for decades. And they keep pulling the debt trigger, but they can't get the growth going. And that's the reason why.
Do you anticipate a point in which we can't get the growth going in the US, despite our exorbitant privilege of having the world reserve currency?
Well, good question, Justin. I think you're close now. I mean, I think you're close now because if you're only getting 25 or 30 cents on the dollar, then you're following right back in behind Japan. And we're in a demographic situation somewhat similar to Japan. I mean, we don't have much growth in this country right now, population growth. You know, the number of children per family is really going down. So all of those things point to a case where, yes, you can borrow more and more money, but it doesn't do you any good. And I'll give you an example. We got ran out of people's offices just about in 1989 and 1990 because we didn't own any Japan. And we kept saying, oh, wait a minute, you know, the average multiple is 100. These are not the kind of companies we want to own. And we went through the whole thing, but it had been so hot the last 10 or 15 years that people were like, oh, you got to own Japan. And so we didn't own any, okay? So if you look at the Nikkei Dow, from that time until now, it didn't go anywhere. We're talking about here 35 years now, just about, not quite. But when you look at that and think, I'm stuck here for 35 years without making a lot of money. To me, that's what you get to. You get the ups and downs and ups and downs. That will be very hard for the novice investor because they won't know what to do.
I've actually learned recently that many nations are having this population crunch. Even China is having issues getting its population up or to sustain its population. Now, I suppose we're looking at internationally. You mentioned in the late 80s, you stayed out of Japan because it didn't look attractive. As you look internationally today, are there any countries that look particularly attractive or unattractive to you?
Well, Justin, we don't do a ton of things overseas. We do in the growth side. We look at growth companies on the growth side. To us, Europe is just steeped right now in trouble. We don't see anything in Europe that would really work right now. If you had to go overseas at all, you should be looking at, to us, you should be looking at, you know, the smaller countries, either in, you know, in the East, like, you know, the Thailands of the world, that sort of thing, as opposed to what's going. It's a tough market right now because I think there are only very, very few, maybe only 4 or 5 foreign markets that are even for the year or up. The rest of them are all down for the year.
Europe seems to be stooped in crisis. Can you speak to that? Is it political or economic crises or a little bit of everything?
Well, they've had centuries now, a couple of centuries of really going more and more. I should say they've got more in an area where the government controls too many things. You know, they've taken a lot of the entrepreneurial spirit out because taxes are high. There's so many things going against somebody that lives in Europe, even though it's a great place, don't get me wrong, but you have to go back to a time when you create an atmosphere where, hey, if I want to go out and take a big risk and I can make some money, or we can trade with other people and that sort of thing. And we haven't gotten that in Europe. I think to a large degree, the thing that hurt that was the euro. When they introduced the euro, basically in 2000, I said, hey, you know, that's not going to be good because you'll have some really strong countries, really weak countries, and they need to stay that way. In other words, you need to be doing business with the strong ones, but see, the euro covers everything. And so I always felt like it might not make it in time. It has made it, obviously, but other than the UK saying, you know, the UK is on their own. But I think that's the trouble with Europe right now. It's steeped in so many things over the last 3 decades or so that very hard for them to get up and become a vibrant place for people to really go out and create, you know, a lot of business and that sort of thing.
It's tragic to see what's unfolding on the European continent economically and politically, but And it does bode well for, I think, the US dollar. It seems that, again, still to this day, the US dollar is in many ways the safe haven fiat currency. Would you agree with that?
Well, it certainly has been. I mean, if you look at trades that clear currency in the world, you know, 2/3 of them, probably close to that, 65% still clear in the dollar. So it's maintained that overall. It's been stronger than I probably expected. And another anomaly is the dollar's been really strong and gold has too. And usually they don't go hand in hand, but I think there's a reason for it now. But I see, but I think that probably continues for the time being, because you're not going to have people, the Chinese wanted to bring the yuan in as a big clearing currency, but really right now it's really the euro and the dollar.
You mentioned that the public is speculating in the stock market. We see this in apps such as Robinhood. People are able to make trades at the click of a few buttons. What advice do you have for particularly young people who maybe have cash flow for the first time when it comes to saving and investing?
Justin, that's a great question. And I've had a number of young people, not only children of clients of ours, but also just young people I know that have come to see me or talk to me about things. And it's interesting about them right now. They've done, they've made some money in crypto and some of the speculative areas, and I don't think much about saving at all. And by the way, it's not a disparaging remark, but they don't listen to you either. When you're trying to say, hey, look, maybe you own whatever you wanted to own, let's say in Bitcoin, that's fine, whatever percentage that is, but just, have a balanced percentage. So you have some other things, including liquidity, by the way. They don't go that route very much, and most of them don't listen. And I find that most of them don't really create a lot of savings, because a lot of them don't have it. But now I'm speaking primarily of under 40 here, okay? And that's what I see the most of. And I try to stay in contact with a lot of them, but that's the way I read that group of people right now.
What does that mean for, I guess, the US economy moving forward? I mean, we've got essentially a couple of factors here. Now, I was really racking my brain for a while, and I kind of feel dumb in retrospect having to rack my brain, but why were employers having trouble finding employees? Well, it seems obvious to me now. There must have been really exorbitant welfare programs in each of these states where people were able to get enough money to sustain themselves above and beyond the stimulus that the federal government was giving them, because everyone was talking about stimulus. Didn't seem to me that was enough money in order to sustain an individual for more than a month. Now, it seems obvious now, it must have been that people had unemployment, particularly coming in at that point. And then now they don't have a mindset of savings. They're more speculative. What does that kind of mean for the, I guess, the body politic or kind of the US economy moving forward, in your opinion?
Well, I think primarily they probably either spent a lot of that money, because, we had, not only did we have unemployment, we had state, we had federal, we had childcare, we had so many things going at the time, even for the very small businesses and 1 or 2 person businesses, that PPP. So there's a lot of cash came in and that sort of thing. Now going forward, you don't have any of that. So, in time you run through the cash. The last payments that I'm aware of were in January, which were the credits, and they had one more set of payments, and they came out in January. So after January, but from February on, we're going to start to see an economy that has to just function on the normal things. I have to get a job to make money, et cetera, et cetera. And I think that's where we are right now. I mean, I think you're going to go back into what I said earlier, which is back into more normal times with things. And so we'll see if it pans out that way.
On the topic of Bitcoin in particular, so I kind of divide cryptocurrencies into individual categories. Bitcoin would be a category of its own. Then there's crypto, and you can kind of go into little subcategories there. But Bitcoin, I would define as its own commodity, asset, whatever you want to make of it. So on the topic of just Bitcoin specifically, I suppose, what has it been like watching it over the last decade? And what is your general opinion of it?
Well, originally, I think it came when you look back around 2014 or so, 14 or 15, I think it came as an idea that, hey, we're going to have our own currency, not have to deal with a fiat currency, et cetera, et cetera. I don't think it's that way today. I think today it correlates with speculation, correlates with the NASDAQ, if you want to really correlate it with something. I do think it will survive. I don't think you'll end up on the other side of an economic downturn or something like that without, Bitcoin. I don't know where it trades or anything like that, but that's sort of what I see. I think the trouble, Justin, will be when you get below those top 3 or 4. And I pulled up beside last week. I had 9,411 coins. Okay. Well, this is just a guess. Okay. But I would guess that 9,000 out of the 9,400 won't even be here if I had to guess. So my advice to people is, be sure you know what you own here and what can survive. It's all about surviving to get to the other side. And I think coming with Bitcoin will be a lot more blockchain technology build out, that sort of thing, which is obviously going to be a method to be used. So that's coming. But I think young people have gotten caught up in, particularly let me make a phone call to my friend in this crypto that you've never heard of in your life is trading at a penny. And so you can buy tons of it and it goes to 80 cents, let's say. Well, yeah, you make a lot of money, but there's nothing to it and it goes away. And somewhat similar in NFTs. I think what happens is there's probably a market for some of that, but I think people have gotten carried away in it and we'll have to see. I mean, I've been through Cabbage Patch Dolls and Beanie Babies and all that stuff. I've been through that before where that's what you had to have. In the 80s, you had to have a drilling rig. I mean, and people all over the United States were trying to buy little pieces of a drilling rig. Well, when times go bad, drilling rigs sell by the pound. So you have to keep in mind what you own.
Has Oxbow Advisors ever considered, in, for instance, the high risk portfolio holding Bitcoin specifically?
Interesting you ask. We own the Bitcoin Trust for about a year and a half and sold it. It went, we made, it was, by the way, we want to put a tiny bit of money into it. And we sold that when Bitcoin in December 17, when Bitcoin got up to 20,000. And it was, you don't think about it now, but it was sort of a new phenomenon right there. And, in 15, 16, and 17. And we sold it. I don't think we sold it because, number one, we made a lot of money in it, but we had just put our toe in the water. We weren't really thinking about a great return, but it ended up being a great return. But we just put a little tiny bit in, and then we never came back to it. It seemed to us to proliferate. Everything was getting to a point where there are more coins and this, that, and the other. So we just said, and what happened is it did start to correlate with the markets. And so that told us that Bitcoin probably can't be a currency because it fluctuates too much. You can't have a currency that fluctuates up or down 40, 50%. It's not going to fly. Now, for other things, might work, but I don't think it will replace currency.
So in 2021 at Bitcoin Conference 2021 in Miami, Florida, there was they said 12,000 people there. It was a lot of people, however many it was. And that is really where I understood clearly that we had different sort of communities forming around these digital assets. Bitcoin was one, and the rest are a different one, are just a different community altogether. There's a lot of overlap, as Mike McLone, a crypto and commodity strategist at Bloomberg, notes, between the US kind of conservative movement and Bitcoin. And he believes that Bitcoin will catch a bid from these individuals later rather than sooner, but at a certain point. Now, I think what the Bitcoiner argues in terms of, well, there's all these different coins, which might devalue the value of Bitcoin or the perceived value of Bitcoin, that In fact, there will only ever be 21 million Bitcoins, and that makes it a unique asset in and of itself on the planet. There's no other commodities, they would argue, that you have a set number of, and that won't change. And they would argue that all the other coins have nothing to do with Bitcoin. These are basically knockoffs. They call them altcoins. So literally every other cryptocurrency is defined in relation to, as an alternative to Bitcoin, or rather just in relation to Bitcoin, which I guess people see as sort of the gold standard of cryptocurrency. Do you have any thoughts generally on Bitcoin and its cap of 21 million and how that might help it find a real value? And then also I want to speak about it in the context of gold. And there is this silly debate that is ongoing between individuals where it's gold versus Bitcoin. And I tend to see these as like a part of a balanced portfolio. They're not competing with each other, in other words. Do you have any thoughts on the gold versus Bitcoin debate?
Well, I was in an interview here just a week ago, maybe or so, or maybe a little less. But one of the things I mentioned was, if I were in Ukraine today, and I've got to leave tonight, okay, and if I have my gold, I can take gold with me, and take quite a bit of it in a small holding. But if I don't have any electricity and I don't have a phone or computer, Bitcoin's not going to do me any good right now. So you have to distinguish between what you want to do with it. Gold is, people talk about inflation and deflate, deflate, inflate, but really where it really does well are times when people are really concerned about the craziness in the world and uncertainty going on. And I think that's the difference between gold and, say, a cryptocurrency, is that, it's a hard asset, much like real estate. You just happen to be able to take it with you. And so that's probably the difference between the two. I'm not saying that you're crazy for investing in Bitcoin. I'm just saying in certain settings, gold is going to be the preferred asset.
I heard a famous investor, I forget who it was, it might have been Ray Dalio, basically say that you want to be prepared for any sort of eventuality when you're investing right now. So you have people who say you want to get into gold and silver because of inflation or the economic crisis. I think that who I believe was Ray Dalio was saying was that you want to be ready for pretty much anything. And so I interpreted that as, all else equal, generally speaking, you don't only want gold and silver. You might want to explore platinum and palladium, which might catch a bid for various reasons. There's also now for the bullion investor, different types of metals that you're able to buy in bullion form. We could argue that, people won't recognize this, et cetera, but I'm speaking really strictly just from investment perspective. When it comes to commodities generally, what is your view? Is it just gold? I mean, do you think silver, which some have argued on this show has been demonetized and is now just an industrial metal, is a safe investment? And then furthermore, the other metals like platinum, palladium, and some of the others.
Well, I'll just take gold. Gold, to me, if you're going to own something, you need to own gold and copper. I mean, if you look at copper, obviously there's not enough of it. It's probably going to be the primary metal if you want to think about the greening of the countries in the next 10 to 20 years. I mean, you're going to need copper. So you have to look at copper. Now, past that, silver is also going to, it's needed, and it tracks gold. It just has a higher beta. You'll find it moves around more for us than gold does. But there's nothing wrong with owning it. Now, when you go over into and think about Russia now, I think they're 7 or 8% of the palladium. But if you take, there's 2 or 3 or 4 of the precious metals that'll probably do well too, and you'll need those as well going forward. We don't trade those, but I think they're tradable, but we don't happen to trade them. But when you get down to it, I think it would probably be, those 6 or 8 metals, and that's where you would want to concentrate.
The EU recently released a document about nuclear power being greener than it's been advertised as. Seems to be that if certain individuals or officials are warming up to this idea that nuclear is actually a clean energy source, which leads a lot of people to think that uranium is going to have a big decade. What's your view on uranium?
Well, we do not own it, but I think uranium will do well over the next 10 years. You know, I think nuclear power has gotten a bad rap. I mean, there's been a couple of things that went wrong in a couple of places, obviously Chernobyl, et cetera. But I think when you look at the amount of power that's been produced by nuclear and how many years it's gone on, you know, it has a good track record, and it is easily the cleanest energy there is. And maybe somewhere in over the next 50 years or something, you're able to develop nuclear that is really, really safe, and people have a safety feel for it. If you did that, you would solve a lot of things that are going on today. But I think you're going to have a move in uranium, not just because of nuclear, but because you use uranium for a lot of things. It just has to have uranium by itself. So I don't own it, but I wouldn't be surprised if it doesn't do well.
Since the last bull market in gold and silver, we saw some other bullion products come on to the retail market, such as Rhodium, for example. What are your thoughts on Rhodium?
I don't have any on that, Justin. We don't, you know, I tend to stay, if I don't know something fairly well, me just talking about it would be a waste of time. And we don't trade it, and I don't know much. I don't really know the market that well with it.
And for me, it kind of fits into this notion that, like, if you're a bullion investor who isn't just worried about, you know, financial crises or economic crises, that according to what Ray Dalio, I believe, said, that this might be a form of diversification to own just a little bit of this. And of course, not going crazy with it, but it might be one form of diversification. And the only critique I hear from that is that, well, no one knows what Rhodium is or looks like, et cetera. As barring, you know, as long as human society continues functioning as it has for so long, you can probably find a buyer who understands it and might take the time to buy it down at your local coin shop. Now, the miners. Can you give us a general overview of the miners who have been through interesting time period here, and really in 2022 seem to be getting going? It seems that there's a lot of buzz in that industry. There's a lot of talk of mergers and acquisitions in that industry, and generally a lot of increasing exploration and continued mining. What's your general overview of the mining sector in 2022?
Well, Justin, what happened is, you know, we started looking at the miners when gold was on a low back in 15, 16. And what was true then is also true now, and that is their price to cash flow multiples have never been this low. These companies are making a lot of money, and they restructured everything the last 25 years where they got their debt in line. You know, they know now how to go out and really either develop a mine or buy a mine. And you see a lot of that going on. The large ones are having a tendency now to go out and say, okay, well, we'll buy a small mine rather than spend all of this development money to get a mine going. Not that they're not doing some of that. But if you look in general at the miners, they are really, really cheap relative to cash flow. And so you let gold go to $2,500, $3,000 an ounce, and you'll see this group really, really, they've already come alive this year. Don't get me wrong. They're playing, and they're really working well this year, but we really think the future ahead of them is much better.
When it comes to gold mining, where are you looking? Is there a particular region or jurisdiction that you're looking at? Is it just cash flow to debt ratio? What are you looking at the junior miners?
Well, we don't do much in the juniors. We think that's sort of a waste of time, because you would have to really, really know where you were to make money in junior miners. But what for us, and I'll tell you what we own, you know, we own the, you know, first and foremost, we own Franco Nevada because we like the royalty side. If we own the same thing in oil, we have companies that do oil royalties as well. So what happened, the royalties we like is because you don't put any capital outlays out. What happened, the price goes way up, you just benefit from that. So that's first and foremost, you ought to own that, in our opinion. Then you'll see us on Newmont, you know, and then you'll see us on Agnico Eagle. And the reason we do is because they both have, particularly Newmont, you know, has almost a 4% dividend. It had better than a 4% where we bought it. but Agnico is a dividend as well. So we're getting good cash flow, and we've got good exposure by two companies where, when the institutions come looking for miners, they will not be going to the juniors, not most of them. They'll go to the ones that are really, really liquid, which are the big ones. I mean, we don't own Barrick, but they'll go to the Barricks of the world and Royal Gold. They'll go that direction, plus the ones we own. And that's how we play it. Now, we own half miners and then we have half bullion. So we try to work it from really both sides.
Ted, I really appreciate your time today. What do people need to know about Oxbow Advisors?
Well, Oxbow has been around a long time. We work with so many business owners that have sold their companies over the years. That's how we created some of the billions we handle right now. But in addition, we have a tremendous amount of experience at Oxbow. And if you go to oxbowadvisors.com, you'll see a lot of writing we've done, a lot of books you can order, a lot of things that make common sense, not Wall Street sort of jargon, but common sense to you as a money person. But that's really who Oxbow is. And you'll find us to be very, very balanced. And that's what we try to be.
We've had the honor and privilege of sitting down today with Ted Oakley, managing partner of Oxbow Advisors. Thank you so much, Ted, for your time today.
Okay, Justin, thanks.
And thank you everyone for listening.